Well, let's look at the last 10 years to get a feeling for just how much the world has changed. If you go back to about the year 2010 is when fracking and the oil business really started to take off. And those first 4 years, I could just say were go, 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 go. The name of the game was to try to lease acreage because now we had to learn to lease larger chunks of acreage for these horizontal wells, drill a few wells to prove up the acreage, and then sell it. There's a wonderful company here in Wichita Falls that has a great story of how they did exactly that and got the biggest pay date they'd ever had in the oil patch, like on the order of 70 or 80 million dollars. And the focus was on growth. And so the profits that you took, you put them into more wells. And if you raised more money, you put them into drilling more wells because it was go, go, go. Then in late 2014, the price collapsed from $100 a barrel down to, it got as low as $26 a barrel for a few days, but really it kind of went down into the 50s and just kind of stayed there, and it stayed in the $50 to $60 range. And other than being a huge shock to the heart, what happened was the lower quality shale assets kind of got left alone. The focus became in oil, the Permian, and in natural gas, the Marcellus, and also the Haynesville. So only the best property became the focus because it was possible to make a profit at $50 to $60 a barrel if you did things very efficiently and right. And all along, I would say the industry was hoping that the day of $70 and $80 a barrel oil just was not too far into the future. I attended many conferences where you would hear people talk about how oil is going to go down, but also how oil is going to go up. And so there was this feeling of if we can just hang on and be a good operator, things are going to get better. But in the last couple of years, and again, these are approximates, the world started to change. The first was, remember I told you how private equity was a buy and sell mindset? Guess what? After the go, go, go era, and after people start to realize higher prices might not be ahead, then the private equity companies had to become happy with a buy and hold strategy, which is now I need you to drill out all that property and make it as profitable as you can so I can start paying back my investors. Investors also became very restless and said, stop investing so much in drilling more wells. I want you to start giving me money back because all I've done is pump money in and I've got nothing to show for it. And so investors became restive. Public investors began to grow very cold towards the publicly traded companies in the oil and gas sector. Why? Two really good reasons why. The first is that if you look at energy stocks, they've stunk. So the red line on the chart is the S&P 500 over the past 5 years. The blue line is a Vanguard energy traded ETF that's just a sampling of the largest, mainly the largest publicly traded companies. Well, duh, not very hard to see why people haven't been interested in investing. And perhaps you could make the case now is a great buying time for the energy stocks because they're so beat down. So people have soured on them because they see this as a commodity industry that's driven by commodity price and also one that perhaps peak demand is not too far away. And then there's also the problem that oil and gas companies are having with public perception. In this sector, they talk about ESG, that stands for environmental, sustainability, and governance. Really, E&P companies have always had pretty good governance. So the focus is on the environmental and sustainability. And this is dependent on where you come down on climate change and fossil fuel and what you think the future of energy. We're going to have a range of opinions on that. But what you're seeing is that more and more voices are telling companies that they should not, investment firms, that they should not be putting money to work in fossil fuel-based companies. So the picture that you see on the chart is a protest in London, but this was taken just before Christmas 2019 at a demonstration in London. And you can see in there Goldman Sachs, major investment bank in the United States, said that they were not going to invest any money in any project that was to drill in the Arctic Circle. This is coming up more and more. I'd like to liken it towards my childhood when cigarette smoking went from a very common, publicly accepted thing to being increasingly perceived as bad. And the cigarette companies went from good investments to really look down upon investments. In fact, in my personal portfolio, I don't knowingly invest in cigarette companies. Just feel like I don't need to make money that way. Even though I am not equating cigarette companies to fossil fuel companies, because I think you can say the fossil fuel companies do a lot of good, although they have some negative side effects that need to be managed. Um, you can't liken the two, but in public perception, it's not looking very good. And so then we had all of these shifts that were already going on, and boom, COVID in 2020. And we saw the Saudi-Russia price war cause prices to go down, and then COVID tanked demand. And what we're seeing is now that the energy industry is basically accepting that $40 to $50 a barrel oil is going to be around for a long time. And because of that, both the debt market and the private equity market are very concerned about making any additional investments in oil and gas. I'm going to have you read an article, and they're going to talk about just how much money, hundreds of billions of dollars, have been put into the E&P companies that really there's no hope that they're ever going to get back. Some banks that were doing the reserve-based lending have actually completely exited the business. They don't want to do any more energy loans. Other banks have pulled back. We've already talked about in the class that more bankruptcies are likely, and what we're really starting to see this fall is a consolidation among companies, and it's a bid for scale. Chevron, a major, buying Noble Energy, a large independent. ConocoPhillips, a major, buying Concho, a large independent. And as if I can't write it any better than this, literally the afternoon as I make this video, it was announced that Pioneer and Parsley Energy have tentatively agreed to join together. So again, there's this feeling that scale and efficiency is going to go forward. What I'm going to have for you to read on the web as you prepare for class is an article from Oil and Gas Investor that talks about how do companies become investable again in 2020, and also a slide deck from a recent investor presentation on Parsley. And what we're going to do is we're going to talk about both of those in class. So very dynamic time in the world of energy financing. What an exciting time to be discussing these topics in class, and I look forward to our discussion in class.